Imagine this. You have been investing in SIPs for years, but one day you meet your friend who started with the same amount as you, yet his wealth has doubled. What did he do differently? Did he pick better SIPs, rebalance smarter, or did he just understand something that you don't? If you want your SIPs to work harder for you, don't miss making every SIP count this Saturday. Picture another investor. Everyone is buying, they are selling. Everyone is panicking, they are investing. Sounds risky, right? But somehow they'll win. How do they see what others miss? That's the power of contrarian investing. Learn how to go beyond the crowd and spot better opportunities. And what if I told you that with just 5k or 10k SIP, you could actually build a 10 lakh portfolio? It's too good to be true, right? But is it? Find out in the exclusive women-only webinar, Kodeeswari Investment Formula. But wait, what about your overall investments? Are they really aligned with your goals? Are you balancing risk and returns right? If you're not sure, then Asset Allocation Decoded is a must-attend webinar. And on Sunday, as a bonus, we tackled the big question, direct versus regular mutual funds, and which one is right for you. Are you leaving money on the table without realizing it? It's all happening this Learning Saturday and Sunday. 5 power-packed webinars, real strategies, and zero fluff. Don't miss out. Register now.
Welcome to today's episode of Talking Straight with Mr. Shyam Sekhar. Today we are going to be discussing about the current market context, different types of investors, how we should aspire to do bigger things, and a lot more. Thank you for taking the time out to speak to us today, sir. I think today we are going to be discussing about a lot of things that has happened in the last 2-3 months. Largely, my observation in my interactions have been that whether an investor has seen multiple cycles or whether they are new investors, they seem to have similar questions and concerns when it comes to what has happened. So their questions are usually, has the market bottomed out? Will it fall much more than this? My portfolio has fallen, so what should I be doing? So what should these people do at this level? And also what kind of mental preparation is required for an investor in a market like this?
Firstly, I think every portfolio is bound to fall when the broader market falls. Some portfolios may fall a little more, some may fall a little less. That entirely depends upon what kind of portfolio construction you have. Suppose you are having a very financial heavy portfolio today. Suppose you had only banks and you had a few defensives, then probably you should have done well. But this market has kind of mixed it all up. So if you look at this market, the biggest loser is FMCG within the Nifty, one of the biggest losers. Then IT has lost significantly. So it's just financials standing like the last night, and it actually didn't perform. These financials in the Nifty didn't perform. So the fact they didn't lose is today performance, right? Now nobody would have anticipated this a year ago because everybody was seeking performance,
right?
And they wanted to avoid financials. So if a portfolio did not have high weightage of financials, it would have fallen a little more. This is at the large cap level. If you take the mid cap level, the fall has been quite sharp and probably there is still more to see in that space. If you take small cap, I think that if the economy slows down further, then the impact will be higher on small cap earnings. And when there is a higher impact on earnings, there should be a impact on the multiples also. So largely this market is again going back to becoming very large cap heavy, though we are not seeing that yet. Now, should one worry about his portfolio going down further from here? I think you should always be aware of what you own so that you can possibly minimize the damage in some parts of your portfolio. Like, I have been a votary of selling small cap funds through last year. Even if somebody did 12-month SWP throughout the calendar year, they would have gone to cash. But people were stubbornly refusing to take money out of that space. The reason why I felt that was a good trade to pursue was that I saw that there could be a 20-30% drop in the valuation of small cap mutual funds. I'm talking about the mutual fund space.
Right.
And now, if somebody has not done that, should they actually take out money now? Or should they wait for a rally and then take out money? These are all questions people have in their minds right now. I would think that if there is a rally before the month of May, you should use that rally to sell out of parts of the market where you still find the valuations to be high. That should be done. And you should align your portfolio to the market. If you're going to have a large cap driven market, then you should own a reasonable amount of large caps. I think people are extremely underinvested in the safer parts of the market and overinvested in the riskier parts of the market. I think this trade has to invert. And I think we have some time to do that, but not too much time. So those who are worried about their portfolio should not sit around just worrying. I think you need to act in some places. That's what I think.
Right. So what can an investor probably expect from his portfolio? Obviously, depending on the construct. But overall markets wise, what can they expect in a 2-year time frame, 5-year, 10-year? How can they mentally be aligned to what they can get?
I would think in a 1-year time frame, you should expect nothing. Personally, I would have very low expectation even on a 2-year time frame. The way I am looking at this market is, I have got 2 years to build a portfolio that will deliver performance across 5 years. This is my calibration towards the next 2 years. So I am not unduly anxious to see performance in the next 2 years, but I am very anxious to invest in all the right places over the next 2 years. Why? Because I think that a new set of sectors, themes are going to come into the limelight over the next 5 years. And I want to ensure that adequate exposures are created in each of these areas. So that is my focus. And you can't do that overnight. You should give it time. You should allow it to mature, the trade to come to a place where it's extremely attractive. And at that moment, you should not miss out investing. See, a lot of people, they keep watching. All the way down, they keep watching.
Right.
And after a bottom also, they are watching. And then when it rises again, they are watching. And they only play a watching game, thinking they're playing a waiting game. So it becomes a complete miss. I think over the next 1 or 2 years, the key thing for me would be not to miss what I want to do. Because if I miss now, it's probably another 10 years away to get the same chance in the same themes. So themes give you an opportunity, like building materials gave us an opportunity 15 years ago. Something else should give us now. Maybe even building materials may again give us the opportunity now. So you need to focus on your opportunities and you need to capitalize on those opportunities. See, the game of waiting can sometimes be overplayed by people. Most of the time, the waiting people look smart for some time. And when they overdo it and when they overplay that hand, they end up looking not so smart. I think the priority now should be to turn from looking smart now to looking smart 5 years later. And that calls for a mindset shift. I think a lot of people who are waiting should do that.
Right. I think that kind of answers my next question, which I had in terms of there are people who have not participated in the last 12 to 18 months saying that markets have been expensive and they want to wait in the sidelines. So I think you've already answered my
No, there is something I want to add to that. A lot of people who haven't participated in the last 12 to 18 months, that is who have sat it out, need to still think about how they want to participate. Even after you decide to participate, no? The reason people don't participate is they don't have a clear answer on how to participate.
Right.
I'll give you an example. I wanted to buy the shipyards. And a friend of mine and I were continuously debating which is the best shipyard. There are 3 or 4. Finally, we ended up not buying any because we are not able to make up our mind on one. I'm giving a simple example. in hindsight, it looks so simple that we could have just bought all four and then decided which one to retain.
Right.
So if you are in that kind of an inertia, or if you are in a state of mind where you're indecisive, I think you must still come to a decision. Being accurately right should not be your obsession, because in the name of being accurately right, you end up not doing anything.
Correct.
I'd rather be approximately right than becoming wrong in the name of seeking accuracy.
Right.
Right?
Understood.
I think that those who have been waiting, wherever they want to invest, I think they need to stagger and keep investing so that they start on that curve, and once you're on that curve, you won't stop. Because you would have done a few things, they won't work initially, you buy and then it goes down 20%. And then you see that it becomes more attractive. What will you do? You will call yourself to more action, you will do more. And then it drops another 10%, you will do a lot more. And when you keep doing this, if you are doing it in the right place where your conviction is well built and strongly founded on fundamentals, then what happens is, if it's going like this saucer formation, by the time it comes from here to here, you build your position. And when it goes up, it's like a takeoff of a flight. You just sit back.
That is what the next 2.5 years is going to be about.
No, next 2.5 years, you have to do this and come here. Next 1.5 years, you have to do this. And then we don't know when. It could even be short-lived. I mean, this whole opportunity, which I am saying can be 1.5, 2 years, can become only 7 months. It could be 1 year. We don't know.
Right.
From getting your investments going, you have to invest. I don't think people should just sit out. I know a lot of people make a big virtue out of the fact that they sat out of cash in these 2 months and all that. I think these kind of things are more posturing, and they don't have much meaning in the long run. If you look at my own experience, I have been invested most of the 36 years of my investment experience, and I have not done too badly. I have always tried to make my portfolio better in the most difficult times. So if there is something which we do which we don't like after some time, we have the opportunity of changing that. But not doing anything generally leads to an inertia from which it's very difficult to come out of. I think a lot of people don't do anything. Even when the market goes up, they keep watching.
Yeah.
I think that should not happen now, and I'm particularly emphasizing to those who have sat out these 18 months
Right.
to get out of the inertia and get going with their investments. They should start investing.
Right. So I think we discussed two groups of investor. One, people who are more proactive, want to know what's happening and how to action their portfolio. Second is people who have not done anything, especially in the last 2 years. I think this brings us to a third category also, where there are people who have investments and exposure to equity markets, but they don't want to do anything at this point. Neither are they too anxious or perturbed, or neither are they willing to participate or contribute more or do anything on the portfolio. What is your word of advice for them?
No, I think that you should never be too lazy or too thinking. I think you need to have a certain level of activity, and you need to bring your thoughts to decisions. I think coming to a decision stage is something that must be practiced, at least in some parts of the market. You don't have to buy the market. You don't have to buy the whole market. But at least some sector which you think is attractive, some specific stocks. So there you need to keep working. Not doing any work generally is not healthy, because you end up not working at the time when you ought to be working. Okay, so that is very, very critical. So people like me are more comfortable working all the time. But we may not call ourselves to action. Thinking that, oh, I'll think about equity next year. All that is a bit of a stretch. I think it's taking it a little far. Investors should work on the ideas constantly, so that the ideas hit them at a time when they should be buying. If you're not in touch with the ideas, if you're not looking at ideas, then you're going to be disconnected with the actual market. And being disconnected is never going to take you near opportunity when it's the right time. So you need to be connected. So I think that is really where a lot of people probably can do better.
Thank you for watching this episode. I think our key takeaway has been about how an investor should be acting on their portfolio today and participating over the next 1 year and be in touch with the markets. In the second video, we are going to be discussing a lot more about how we can achieve these and how to set ourselves up to do bigger things.